This video is for educational and entertainment purposes only and is not financial, investment, tax, or legal advice. Discussions of ETFs, investing strategies, market updates, or specific funds are general, not tailored to your financial situation, and should not be relied upon for decision making. Investing involves significant risks, including total loss of principal, and past performance does not guarantee future results. I am not a registered financial advisor. My content reflects personal research and publicly available information. I may earn affiliate commissions from mentioned products or links disclosed per FTC guidelines, but these do not influence my opinions. Always consult a licensed financial professional and verify information independently. By watching this, you agree I am not liable for any losses or consequences from your actions. International viewers should consult local regulations. I've been covering some of the best ETFs for maximizing dividend income, and the most popular ones are covered call ETFs. These ETFs use a covered call strategy on their underlying holdings to generate premium income, which is then distributed to investors as a dividend yield, typically upwards of 9 to 10%, and with some even reaching up to 20%. These extreme yields make them very favorable for income investors and retirees who plan on living off their portfolio's income. As a result, these ETFs have amassed billions in assets and have become one of the hottest trends in the market. However, despite their growing popularity, there is one looming question on every investor's mind. And that is, what would happen to these ETFs in a recession where the markets could crash by up to 50%? Given that the yield curve has reverted back to positive after a record inversion cycle, an event historically associated with an impending recession, along with sky-high valuations and record concentration of most major indices, this concern is more relevant than ever. But high-income ETFs are especially sensitive to this topic. Every single one of these ETFs never experienced a recession, and 99% of them were established after the COVID pandemic crash. So investors don't really know how these types of investments would perform in such an environment. I mean, the bear market of 2022 gives us an idea, but the main concern here is whether or not covered call ETFs would be able to recover after a catastrophic prolonged sell-off, something similar to the 2008 Great Recession or the dot-com crash. You see, given the nature of a covered call strategy, these ETFs naturally have a limited ability to appreciate in value. Covered calls place a cap on growth potential in exchange for high income. However, their downside risk is completely open and vulnerable. It's the high levels of income that cushions this downside. If the markets crashed by 50%, then subsequently recovered, how well can these ETFs minimize the downside? How much would they theoretically lag the markets? And would their underperformance lead to prolonged NAV depletion? In this video, I'm going to analyze and break down how different covered call ETFs would respond to a theoretical 50% market crash, figure out which ones are better positioned to outperform others, and discuss specific strategies that fund managers deploy in order to hedge and enhance the total performance of their ETFs. Now, before we continue, I wanted to let you guys know that I just released a free dividend ETF cheat sheet that breaks down the 7 key metrics every smart investor should know, plus my #1 way to spot a dividend trap. You can grab your free cheat sheet by clicking the link in the description or comment section below. To begin, it is important to understand the various ways fund managers deploy a covered call strategy. And there are 3 key components here: the underlying holdings, the strike price of the covered calls, and the expiration dates of the covered calls. So let's start with the simplest one, the underlying holdings. In a recession, almost every asset class will suffer significant selling pressure, but ETFs that are more concentrated will likely suffer more. The concentration of the Nasdaq 100 relative to the S&P 500 could make it more vulnerable in a downturn. So in a potential recession, it is likely that covered call ETFs that track the Nasdaq 100 will suffer more selling pressure than covered call ETFs that track the S&P 500. That means ETFs like GPIQ, JEPQ, QDTE, or QQQI could suffer more downward pressure than ETFs like SPYI, ISPY, JEPI, XYLD, and XDTE. But there are also covered call ETFs that are even more concentrated, like FEPI, which holds only the top 10 stocks within the Nasdaq 100 and sells calls against them. This ETF will likely suffer even more selling pressure than its peers. If you guys want access to these amazing tools along with in-depth fund analysis, market insights, ETF breakdowns, and more, then I highly suggest to sign up with Seeking Alpha. You guys can use my link to get $30 off their annual premium plan. You can also save $160 off their Premium and Alpha Picks bundle. And Alpha Picks is Seeking Alpha's premium stock picking portfolio that uses momentum, quantitative data, and a disciplined approach to identify stocks with the highest growth potential. And since inception, this portfolio has provided 3 times the total returns of the S&P 500. And I personally use these tools together every single day, so I highly suggest you guys take advantage of the sale. So let's move on to the covered call strategy. To begin, there are 2 types of covered call ETFs. Those that sell at the money call options and those that sell out of the money call options. And in simple terms, this describes the cap the fund managers are placing on the underlying holdings. Selling a call option at the money means that you are selling a call option at a strike price equal to the current trading price of the underlying assets. So you are completely capping growth and replacing it with income generation. But selling call options that are out of the money means that you are selling a call option that is above the current trading price of the underlying asset, and therefore you are allowing room for the asset to appreciate while also collecting a substantial amount of income. But there's another major difference here, and that is the amount of income you're able to collect. By selling call options that are at the money, you're able to collect more premium income relative to selling calls that are out of the money. So theoretically, in a downtrend, at-the-money covered call strategies would be able to collect more premium income, which should cushion downside volatility even better. So let's compare the performance of QYLD, which sells at-the-money calls, and JEPQ, which sells out of the money calls, in the sell-off that happened in July. You can see that QYLD cushioned the downside better than JEPQ. If I'm able to collect much more income, then that must be the better strategy in a recession, right? Not exactly. You see, the markets don't fall in a straight line. They fluctuate up and down over the course of many months. Take the 2008 recession, for example, where the markets fell by 15% from their highs in October to November, then recovered 10% in 1 month, then fell by almost 20% the following month, and then slowly recovered again and continued on this pattern until this massive 50% sell-off that took place over the course of 7 months. So given the irregular and unpredictable pattern of the markets, selling at the money call options, although provides more income, will likely work heavily against you over time. And that is because in these upward trends, you want to make sure that your underlying assets have room to recover. So if you're always placing a cap at the money, then the ETF has a risk of portraying a pattern that looks like this. If the market falls by 15% and then recovers by 15%, then falls by another 20% and then recovers 10% and then subsequently falls by another 30%, an at-the-money strategy could cap every single one of those recoveries, but subsequently participate in the selling pressure that comes afterwards. And really all you're getting is a 2 to 3% cushion on every sell-off. But by selling out of the money call options, although you will collect less income, the ETF will be able to participate in those recoveries. And when you include the added dividend income, the total performance becomes even better. If we compare an at-the-money covered call ETF like QYLD to an out-of-the-money covered call ETF like JEPQ, in the bear market of 2022, you can see how different their performances were. And remember, both of these ETFs sell calls on the Nasdaq 100. You can clearly see the cap that QYLD has placed on every single one of these recoveries. And looking at their total performance, you can see that JEPQ has doubled the performance of QYLD. So without a doubt, in a recessionary environment, out-of-the-money ETFs are much more favorable. However, how would an ETF like JEPQ compare to the overall market? Just like the 2008 recession. How would that affect the total performance over time, and what strategies could the fund managers deploy in these situations? First, it's important to remember that in a recession, volatility will pick up a lot. When we look back at the 2008 recession, the volatility index reached record highs. And this chart simply represents the amount of fear within the markets. Now, I've said this before, but ETFs that use option strategies have a heavy correlation with volatility. When volatility increases, option premiums increase as well, and this relation is called vega. So a 5% out-of-the-money call option that would normally provide $500 in premium could potentially provide $1,000 in a recession. And remember, the strike price has not changed here. So given the potential for more premium income, fund managers are able to sell further out of the money call options than they normally would in order to increase the cap on growth potential. This would still allow them to collect relatively the same amount of premium income as they would have collected in a normal market environment, But instead of a theoretical 5% cap, you now have a 10 or 15% cap. That is why I've always mentioned that these ETFs sell 5 to 15% or 5 to 20% out of the money calls. This range is there for the fund managers to decide when it's appropriate to sell closer to the money or further out of the money call options. And they determine this based on a variety of factors, which include volatility or implied volatility of option contracts. But that's not all. We also have to focus on the expiration dates of these call options. And here's the easiest way to understand this. The cap you are placing by selling this call option isn't permanent, and it is up to the fund manager to decide how long that cap stays. So if they decide to put a 10% cap for 1 month, that means that they are selling a call option that is 10% out of the money with an expiration date of 30 days. And within that 30-day time frame, the fund is limited to only 10% appreciation, but has already collected a certain amount of premium income. And that would look something like this. I would sell a 10% out of the money call option on the QQQ and choose a 30-day expiration. Now, notice what happens to the amount of premium income you collect from this call option if I sell at the same strike price but with 60 days to expiration. It doubles in value. This adjustment in expiration is the second strategy fund managers could use in a recession, and here's why. To begin, the increase in option premiums is due to 3 reasons: the time value, implied volatility, and extrinsic value. Now, I know this sounds confusing and I'll explain it in detail in another video, but what I want you to remember is that further dated option contracts provide a larger window for the underlying assets to fluctuate. This increases uncertainty, which increases the value of the option contract. Simple. But why is adjusting the expiration date so important? Well, theoretically, if the market sells off by 30%, selling a call option here that is 15% out of the money with only 1 month to expiration would mean that you are only giving your underlying assets a 30-day window and a 15% cap. So if we see a 30% recovery the following month, the ETF would only capture 15% of it. And now the fund managers will sell another call option because they reached the end of that 30-day window and the options were exercised. So they must repeat the process. But if a subsequent fall of another 30% occurred, even though the markets have now ended up exactly where they were 2 months ago, you only participated in 15% of that rally, but participated in the subsequent 30% drop, leaving the ETF to close lower than the overall market. However, by selling calls with a 60-day window that is still 15% out of the money, although the markets momentarily surpassed the 15% cap, because it closed below it within these 2 months, the ETF's price performance would not only be similar to the overall index, but it would actually be superior because you had this massive chunk of income that cushioned the downside. And remember, you collected 2 months worth of premium income. So overall, you can clearly see how adjusting the expiration dates and strike prices of option contracts can be very powerful risk management tactics. And that is why I think that well-managed and reputable covered call ETFs will still be powerful investments even if we go through a recession. And that is all for this one. If you haven't yet, make sure you subscribe to my channel and hit that thumbs up button for the YouTube algorithm. Thank you guys so much for watching, and I will see you in my next one.